There is a ghost that haunts the graveyard of capital. It doesn't stalk the foolish or the uninformed. It preys exclusively on the brilliant. It is the silent killer of genius investors, the unseen force that turns towering intellects into financial ruin. Warren Buffett, who has had a front-row seat to the cycles of boom and bust for nearly a century, has seen this ghost claim more fortunes than any market crash or economic depression. He's watched Nobel laureates, legendary traders, and visionary entrepreneurs, men and women with IQs that could bend steel, get wiped from the board. And he says they all fall into the same deceptively simple trap, a trap set not by the market but by their own minds. Their greatest asset, their intelligence, becomes a weapon turned against them. It whispers a siren song of invincibility, luring them out of the calm waters of their expertise and into the jagged, unfamiliar shores of risk they cannot comprehend. This isn't a story about the importance of being smart. It's a story about the mortal danger of being too smart for your own good. It is a cautionary tale about the single most important principle for preserving capital and building lasting wealth: the profound, unyielding, and life-saving power of knowing what you don't know. This is the story of the circle of competence, the invisible fortress that protects your wealth from the most dangerous predator of all, your own ego. For anyone who has ever succeeded in any field, for any entrepreneur, any doctor, any engineer who believes their success is a golden ticket to mastering the market, this is not just a lesson, it is a lifeline. Our journey begins not in a frenetic Wall Street trading room, but in the quiet, sun-drenched aisles of a California candy company. The year is 1972. Warren Buffett and his partner, Charlie Munger, are considering a purchase that would become a cornerstone of their legend, not because of its complexity, but because of its profound simplicity. The company was See's Candies. To the titans of high finance, a chocolatier seemed almost quaint, a relic from a bygone era. It wasn't a semiconductor manufacturer, it wasn't a revolutionary pharmaceutical company. It made chocolate. Yet this simple business would teach a lesson that would echo through every major investment decision Buffett and Munger would ever make. The asking price was $30 million. The company's tangible assets, the factories, the stores, the equipment, were only worth about $8 million. The remaining $22 million was for something intangible, something you couldn't touch or quantify on a standard balance sheet: the brand, the name, the feeling a customer had when they walked into a See's shop. Buffett, still deeply conditioned by his mentor Ben Graham's philosophy of buying businesses for less than their liquidation value, initially balked. Paying a premium of more than 3 times the physical assets seemed, on its face, like a violation of value investing. But Munger, with his characteristic blunt wisdom, pushed him. He understood that See's wasn't just a collection of assets. It was a durable institution, lodged in the hearts and minds of its customers. They dug deeper. This wasn't a matter of complex financial modeling or projecting technological trends. It was about understanding human behavior. They could see the lines out the door during Christmas and Valentine's Day. They understood the power of a brand that was synonymous with quality and tradition. A man would never risk giving his sweetheart a cheap box of chocolates on Valentine's Day to save $1 or $2. The upside of saving $1 was minimal. The downside risk of looking cheap was catastrophic. See's had pricing power that was born not from a patent, but from psychology. They understood that this simple, boring business had a deep, unassailable competitive moat. It was a business they could understand from top to bottom. They knew how it made money, selling high-quality candy at a premium price. They knew its competitive advantage, a beloved brand built over decades. And they could clearly see the key drivers of its future: maintaining quality and expanding its brand recognition. It was, in every conceivable way, inside their circle of competence. They made the deal, paying the $30 million. Over the subsequent decades, See's Candies would go on to generate over $2 billion in pre-tax earnings for Berkshire Hathaway, a return that didn't require them to understand quantum physics or predict the future of the internet. It only required them to understand the simple, enduring power of a good box of chocolates. This anecdote is the bedrock of our first pillar. It's the origin story of the circle of competence, a concept that is not about limiting your ambition, but about focusing your intellectual firepower where it can have the greatest effect. It's the radical idea that your success as an investor is determined not by the size of your circle, but by your discipline in defining its perimeter and never, ever stepping outside of it. The psychological principle that underpins the See's Candies investment is a powerful mental reflex known as ambiguity aversion. On a cerebral level, our brains are hardwired to prefer known risks over unknown risks. Imagine 2 jars of marbles. Jar A has exactly 50 red marbles and 50 black marbles. If you draw a red marble, you win $100. Jar B has 100 marbles, but the mix of red and black is completely unknown. Which jar do you choose to draw from? Overwhelmingly, people choose Jar A. The probability of winning is a known 50%. In Jar B, the probability could be 99%, or it could be 1%. The rational mind, according to some economic theories, might see no difference, but our evolutionary brain screams to avoid the unknown. For our ancestors on the savannah, an ambiguous rustle in the grass was far more dangerous than the sight of a known predator. The unknown represented a potentially limitless downside. This is not a flaw in our wiring, it's a survival mechanism. Buffett, in his genius, doesn't try to fight this deep-seated bias. He weaponizes it. He transforms ambiguity aversion from a cognitive quirk into a rigorous investment filter. When he looks at a complex tech company whose future cash flows are a complete mystery, he sees Jar B. The mix of marbles is unknown. The potential for a huge win exists, but so does the potential for total loss. When he looks at a company like See's Candies or Coca-Cola, he sees Jar A. He may not know the exact outcome of any given year, but he has a very high degree of confidence in the long-term probabilities. He understands the business, its customers, and its competitive landscape. The risk is known, calculable. This is why a core tenet of value investing is so simple, yet so profound. Invest in what you know. It's a direct application of this psychological principle, turning a survival instinct into a tool for capital preservation. The market is an environment saturated with ambiguity. By consciously choosing to operate only in areas where that ambiguity is minimized, you are aligning your investment strategy with the fundamental wiring of the human brain, rather than fighting against it. So how do you translate this powerful idea into a practical tool? How do you build your own circle of competence? The process can be formalized into a mental model we can call the Personal Investment Constitution. It's a blueprint for defining your intellectual boundaries with ruthless honesty. Step 1 is the competence audit. You must take a blank sheet of paper or open a new document and conduct a forensic examination of your own life and experience. List every job you've ever held, from a summer job in high school to your current executive role. List every industry you have worked in or have direct, hands-on experience with. List your most serious hobbies, the ones where you have spent hundreds of hours developing a deep, practical knowledge. This isn't about what you've read in a newspaper, it's about what you've lived. The goal is to create a raw, unfiltered map of your personal intellectual landscape. Step 2 is the 3-layer test. For every single item on your audit list, you must be able to answer 3 questions with depth and precision, as if you were teaching a college course on the subject. First, how does this business or industry actually make money? Not the glossy version from the annual report, but the nitty-gritty mechanics of its revenue and profit streams. Second, what are its durable competitive advantages? What protects it from a smarter, cheaper competitor? Is it a brand, a network effect, a regulatory barrier, or a low-cost production process? You must be specific. Third, what are the 2 or 3 key variables that will determine its success or failure over the next 10 years? If you cannot answer all 3 of these questions without resorting to vague jargon or guesswork, that item, no matter how familiar it seems, is outside your circle. This test is the filter that separates true competence from casual familiarity. Step 3 is drawing the line. Based on the results of your test, You will create two lists. On one side, the industries and businesses that are definitively inside your circle. On the other, everything else. This second list is your too hard pile. This document, your personal investment constitution, now becomes the single most important tool in your financial life. Every investment idea, every stock tip, every market narrative must first pass through this filter. If it falls outside the circle, you discard it instantly, without further analysis, without regret. This isn't about being closed-minded. It's about achieving a state of profound financial discipline. It is the act of building the walls of your fortress before the battle ever begins. Now let's explore the opposite approach, the path that the vast majority of investors take, often to their own detriment. This is the path of the 99%, the antithesis to the circle of competence. It is the path of chasing the narrative. Instead of starting with what they know, they start with what is hot. Their investment process begins with a headline, a TV segment, or a tip from a friend about a stock that is soaring. They hear about the revolutionary potential of artificial intelligence, the paradigm-shifting power of cryptocurrency, or the untapped market for a new biotech drug. The narrative is intoxicating. It's a story of a brilliant future, and the rising stock price seems to confirm it. They mistake the movement of the stock for the quality of the business. They have no personal experience in enterprise software, blockchain technology, or molecular biology, but they see others getting rich, and the fear of missing out becomes an unbearable psychological weight. They buy the stock. They might even try to do some research, which usually consists of reading a few bullish articles that confirm their decision. They cannot answer the three-layer test. They don't truly understand how the company makes money, what its real competitive advantages are, or what the key risks to its future are. They are holding not a piece of a business they understand, but a lottery ticket based on a story. The dot-com bubble of the late 1990s was the Mount Everest of this phenomenon. Millions of ordinary people, from teachers to dentists, poured their life savings into internet companies they couldn't possibly understand. They bought shares in companies with no profits, no clear business model, and often no revenue. They did it because the narrative was that the old rules of valuation no longer applied. This was a new economy. They stepped, en masse, out of their circles of competence in teaching, dentistry, and 1,000 other professions, and into the highly specialized world of venture capital, convinced that this time was different. When the bubble burst, the result was the vaporization of over $5 trillion in market value. It was a brutal global lesson in the catastrophic consequences of abandoning the simple principle of investing in what you know. This is the path of the 99%, a reactive, emotionally driven chase of popular opinion, and it almost always ends in the same place, the graveyard of capital. How does this principle manifest on a financial statement or in a portfolio's performance? The connection is direct and powerful. Staying within your circle of competence fundamentally changes your relationship with risk and directly impacts the quality of your returns. When you are analyzing a business you deeply understand, you can assess the asterisk quality of its earnings, asterisk with a far more critical eye. You can distinguish between real, sustainable cash flow and accounting gimmicks. You can see when a company is prudently reinvesting in its future versus when it is starving its operations to meet a quarterly earnings target. This analytical edge is your first line of defense against what are known as value traps, stocks that appear cheap on a spreadsheet but are, in reality, businesses in terminal decline. The financial consequence of this is a dramatic reduction in the probability of permanent capital loss. A portfolio built on a foundation of understandable businesses has a fundamentally different risk profile. While it will still fluctuate with the market, its vulnerability to a single, catastrophic blow-up is minimized. Furthermore, this deep understanding allows you to act with conviction when others are panicking. During a market crash, when the prices of all businesses are falling, an investor who truly understands their holdings can confidently buy more, knowing the intrinsic value of what they own. An investor who is chasing a narrative, however, will be gripped by fear. Since their ownership was based on a rising price, a falling price shatters their entire thesis. They sell at the bottom, locking in their losses. Over the long term, this creates a massive divergence in financial outcomes. The investor operating within their circle of competence sees their portfolio compound steadily, protected from devastating drawdowns. The narrative chaser experiences a series of booms and busts, a one step forward, two steps back journey that ultimately leads to frustration and financial mediocrity. In essence, the circle of competence isn't just a qualitative idea, it's a quantitative strategy. It is the single greatest tool for ensuring that the mathematics of compounding work for you, not against you, by ruthlessly eliminating the kind of unforced errors that can set you back for decades. It is the very architecture of capital preservation. Our second pillar delves into the dark side of intellect, exploring why the very people who should be best at investing are often the most susceptible to its greatest pitfalls. It is the seduction of genius, the insidious way that intellectual arrogance becomes a financial toxin. There is no better illustration of this than Warren Buffett's own behavior during the height of the tech mania in the late 1990s. As the Nasdaq Composite Index soared into the stratosphere, fueled by a frenzy for all things internet-related, Berkshire Hathaway's stock began to lag. Badly. Financial commentators who just a few years earlier had lionized Buffett as the greatest investor of all time began to write his professional obituary. He was a dinosaur, they said, a relic of an industrial economy who simply didn't get it. Barron's ran a now infamous cover story in 1999 titled, "What's Wrong, Warren?" The article mocked his refusal to invest in the high-flying tech stocks, suggesting his methods were obsolete in the new digital age. The pressure was immense. His shareholders were watching their neighbors get rich on stocks like Cisco and Qualcomm, while Berkshire plodded along. Even his personal friends, like Bill Gates, were at the center of this technological revolution. Buffett had direct access to some of the most brilliant minds in the industry. He could have called up the CEOs of Intel or Microsoft and gotten a masterclass on their business models, yet he refused to invest. His reasoning was a masterclass in intellectual humility. He stated, publicly and repeatedly, that he simply did not know how to predict what the technology landscape would look like in 10 years. He couldn't confidently determine which of the dozens of competing companies would have a durable competitive advantage. He admitted without shame that it was all in his too hard pile. He famously said, "I'm not a Luddite, I'm just an ITE." He knew that his extraordinary talent for analyzing banks, insurance companies, and consumer brands gave him zero edge in evaluating semiconductor firms or network hardware providers. His genius wasn't in knowing everything, it was in knowing the precise boundaries of his own knowledge. He understood that for a truly brilliant person, the most dangerous phrase isn't, "I don't know, but I can figure this out." The latter is the siren song of the ego. It's the belief that raw intelligence is a universal solvent that can be applied to any problem. When the dot-com bubble inevitably imploded and trillions of dollars of speculative wealth vanished, Buffett was not only unscathed, he was holding a mountain of cash, ready to pick up the pieces. His steadfast refusal to venture outside his circle wasn't a sign of weakness, it was his ultimate strength. This anecdote is a stark reminder that in the world of investing, a high IQ can be a liability if it's not tempered with an even higher dose of intellectual humility. The market has a brutal way of humbling those who believe their genius makes them invincible. The psychological machinery behind this phenomenon is a potent cocktail of cognitive biases, with the overconfidence bias and the Dunning-Kruger effect playing the lead roles. Overconfidence bias is the well-documented tendency for people to have excessive faith in their own knowledge and abilities. For highly intelligent and successful individuals, this bias is often amplified. If you are a world-class surgeon, a brilliant lawyer, or a successful entrepreneur, you have a long track record of being right. Your intellect has been your key to success. This creates a powerful feedback loop that can lead to what psychologists call epistemic arrogance. The belief that your mastery in one complex domain automatically translates to mastery in another. You conquered medicine. Surely you can conquer the stock market. This is where the Dunning-Kruger effect kicks in. A cognitive bias where people with low ability at a task overestimate their ability. In investing, a little bit of knowledge is a very dangerous thing. A smart person can quickly learn the jargon, PE ratios, discounted cash flow, EBITDA. This initial superficial understanding can create a dangerous illusion of expertise. They don't know what they don't know. They fail to appreciate the vast, unseen iceberg of industry-specific context, competitive dynamics, and qualitative factors that lie beneath the surface of the financial numbers. The CEO mindset, in particular, can be a major risk factor. An entrepreneur who has built a company from scratch has developed an incredible sense of agency and a belief in their ability to shape outcomes. This is essential for building a business. But the market is not a business you can control. It is a complex, adaptive system that does not care about your past successes or your force of will. When this high agency mindset, fueled by overconfidence, collides with the chaotic reality of the market, the results can be explosive. The very traits that made them brilliant in their own field, a bias for action, supreme self-confidence, a desire to be the smartest person in the room, become the tools of their own financial destruction. This is the psychological trap that awaits the unwary genius. To protect yourself from this insidious form of self-sabotage, you need a practical, repeatable mental model. We'll call it the intellectual humility drill. It is a 3-step process designed to act as a circuit breaker for your ego before you make a significant financial decision. Step 1 is the teach a child test. Before you invest a single dollar, you must attempt to explain the investment thesis out loud in the simplest possible terms, as if you were explaining it to an intelligent 10-year-old. Why is this company a good business? How does it beat its competition? Why will it be bigger and more profitable in 10 years? If you find yourself stumbling, relying on complex jargon, or hand-waving over the tricky parts, it is a giant red flag. It's a sign that you don't understand it as well as you think you do. The need to simplify forces you to confront the gaps in your own thinking. If you can't explain it to a child, you have no business investing in it. Step 2 is the pre-mortem of ignorance. This is a powerful exercise in counterintuitive thinking. Imagine it is 1 year in the future, and this investment has failed catastrophically, losing 50% or more of its value. Now write down the story of why it failed. Crucially, you must frame the reasons for the failure specifically around things you didn't understand. For example, the investment failed because I didn't truly grasp the impact of new government regulations on their pricing power. Or, it failed because a new technology I hadn't even heard of made their main product obsolete. This exercise forces you to move from a state of confirmation bias, where you seek out information that supports your thesis, to a state of active intellectual inquiry into your own blind spots. It is a powerful tool for cultivating the CEO mindset of paranoid optimism. Step 3 is to appoint a devil's advocate. Find the most intelligent, skeptical person you know who is willing to be brutally honest with you. Present your investment thesis to them. Your role is not to defend your idea. It is to shut up and listen. Encourage them to tear it apart, to find every flaw, every weak assumption. This is not an argument to be won. It is an intelligence-gathering mission. The goal is to see the world through the eyes of a critic. This process is a cornerstone of effective executive decision-making in the world's best companies, and it is an essential discipline for any serious investor seeking to protect themselves from their own overconfidence. The antithesis to this disciplined humility is a path we can call the expert's folly. This is the road taken by the brilliant specialist who believes their deep expertise in one area grants them a special insight into the market. We see this all the time. The cardiologist who, having read a few clinical trial abstracts, believes they can pick the next winning biotech stock. The software engineer who, because they understand code, thinks they can perfectly time the cyclical movements of the semiconductor industry. The geologist who invests their life savings in a single speculative oil exploration company based on a gut feeling about a particular rock formation. They fall victim to a classic error. They mistake technical knowledge for investment wisdom. They apply the analytical tools from their own domain, which are often complex and sophisticated, to the financial markets, but they lack the crucial domain-specific context. The cardiologist may understand the science behind a new drug, but they may have zero understanding of the brutal economics of pharmaceutical marketing, the complexities of patent law, or the unpredictable nature of FDA approvals. The software engineer may be able to write elegant code, but they may not appreciate the cutthroat pricing wars, the global supply chain dynamics, and the geopolitical risks that buffet semiconductor companies. They overanalyze the data they are comfortable with and completely ignore the qualitative, human factors that often drive long-term business success or failure. Their portfolio becomes a reflection of their professional ego, not a prudently constructed collection of well-understood businesses. This is one of the most common and devastating investment mistakes made by smart people. They fail to realize that the market is not a scientific laboratory or an engineering problem. It is a swirling, chaotic ecosystem of business, psychology, and chance, and it has a nasty habit of punishing experts who stray too far from home. The direct financial connection of intellectual arrogance is its catastrophic effect on a portfolio's risk profile. A portfolio built with humility and a strict adherence to one's circle of competence is designed to be resilient. A portfolio constructed with intellectual arrogance, however, is inherently brittle. It is uniquely susceptible to what statisticians call fat tail risks, rare, unpredictable, but massively consequential events. The arrogant investor, believing they can figure it out, is far more likely to get involved in complex financial instruments, high levels of leverage, or speculative ventures where the range of outcomes includes a total loss of capital. Their overconfidence leads them to make concentrated bets on ideas they don't fully comprehend. One single, highly leveraged bet on a complex derivative, one speculative play on a biotech company's drug trial, one all-in move on a cryptocurrency they believe is the future. Any one of these can wipe out a decade's worth of patient, sensible gains. The financial signature of such a portfolio is what we can call volatility asymmetry. It tends to go up slowly, in line with the market, but when it goes down, it does so like a stone thrown from a cliff. The losses are sudden, deep, and often irreversible. Intellectual humility is the ultimate form of risk management, because it acts as a gatekeeper. It prevents these kinds of high-risk, low-understanding bets from ever entering your portfolio in the first place. It ensures that your capital is never exposed to the risk of ruin from a single mistake born of hubris. In the long run, the preservation of capital is far more important to your final wealth than the maximization of gains in any single year. A 10-year track record of 8% annual returns is completely undone by a single 50% loss in year 11. Intellectual humility is the firewall that protects your financial journey from that catastrophic 11th year. Our third pillar moves from the philosophical to the intensely practical. It's about translating the abstract idea of intellectual humility into the concrete act of defining your own boundaries. This is the art of drawing your circle. And to understand it, we turn to one of Buffett's largest and, to some, most surprising investments, a railroad. In 2009, at the height of the great financial crisis, Berkshire Hathaway made a massive $34 billion bet on the Burlington Northern Santa Fe Railroad, BNSF. To the world of finance, obsessed with technology and complex derivatives, a railroad seemed like a throwback to the 19th century. It was dirty, capital-intensive, and decidedly boring. But for Buffett, it was a thing of crystalline beauty. It was a business he understood with absolute clarity and conviction. He saw the railroad not as a collection of locomotives and track, but as a vital, irreplaceable artery of the American economy. He knew that moving vast quantities of grain, coal, and consumer goods across the continent by rail was far more efficient than doing so by truck. He understood the immense competitive advantage of owning the physical infrastructure. You simply cannot build a competing transcontinental railroad. The capital costs and regulatory hurdles are insurmountable. BNSF, along with its main competitor Union Pacific, formed a duopoly on land-based freight in the western United States. This gave it durable pricing power. Buffett also understood the long-term tailwinds. As the population grew and the economy expanded, the demand for moving physical goods would inevitably increase. It was, as he called it, an all-in wager on the economic future of the United States. The BNSF investment is the perfect illustration of what it means to operate at the center of your circle. It wasn't about technology, it wasn't about glamour. It was about a deep understanding of basic economics, competitive dynamics, and the long-term needs of a country. It demonstrates that the circle of competence isn't about being an expert in finance or tech. It can be about understanding agriculture, logistics, retail, or any other corner of the economy. The goal is not to have the biggest circle, but to know with absolute certainty where your circle's edge is, and to operate within it with the ferocious decisiveness Buffett showed when he bet the farm on America's railroad. The psychological skill at the heart of this process is known as metacognition. It is, quite simply, the ability to think about your own thinking. It's the capacity for honest self-appraisal, the skill of accurately assessing the limits of your own knowledge. Most people suffer from a cognitive bias called the illusion of explanatory depth. We believe we understand complex systems, like how a zipper works, or how a helicopter flies, in far greater detail than we actually do. This illusion is shattered the moment we are asked to explain it. We quickly realize our knowledge is superficial, a mile wide and an inch deep. This same illusion plagues investors. They believe they understand a business, but their understanding is often just a collection of shallow narratives and talking points. The rigorous process of defining your circle of competence is a direct assault on this illusion. It is an act of applied metacognition. It forces you to move beyond feeling like you know something to proving that you know it. This is a core concept in behavioral finance. The most successful investors are not necessarily those with the highest IQ, but those with the most finely tuned metacognitive skills. They are constantly questioning their own assumptions, actively seeking out their blind spots, and are brutally honest with themselves about what they don't know. They understand that the market is a relentless machine for exploiting those who overestimate their own understanding. By consciously practicing this kind of intellectual self-awareness, you shift your entire approach from one of ego-driven prediction to one of humble preparation, a shift that is essential for long-term survival and success. To put this into practice, we need a more advanced blueprint than our initial audit. We can call it the Circle Mapping Protocol. It is a 4-step method for building and maintaining a robust understanding of your investment domain. Step 1 is the Core Competence Inventory. This builds on our earlier audit, but focuses with greater intensity on your professional life. What specific knowledge or skills does the world pay you for? What problems do you solve that others cannot? This is the absolute center of your circle, your area of deepest expertise. Step 2 is the Adjacent Knowledge Scan. Once you have defined your core, look for the adjacent industries. If you are a commercial real estate broker, for example, your core is real estate. But adjacent to that might be banking, you deal with loans; construction, you see buildings get built; or retail, you understand the needs of tenants. This is how you can begin to cautiously and intelligently expand the boundaries of your circle over time, moving from an area of deep knowledge to one that is closely related, never making a huge leap into the completely unknown. Step 3 is the Information Diet Audit. Get brutally honest about where you get your information. If your research consists of watching financial news channels, reading headlines, or browsing social media, your circle of competence is almost certainly an illusion. Real competence is built on a diet of primary source material, company annual reports, especially the footnotes, industry trade journals, conference call transcripts, and books on business history. You must shift from being a consumer of financial entertainment to being a serious student of business. Step 4 is creating and maintaining a too-hard pile. This is perhaps the most powerful productivity tool an investor can have. Emulate Buffett and Munger and create a literal or metaphorical pile for investment ideas that, after a brief examination, are simply too complex, too uncertain, or too far outside your expertise. The goal of your analysis is not to solve every puzzle the market throws at you. The goal is to quickly and efficiently discard the puzzles that are not worth your time. This act of intellectual triage preserves your most valuable asset, your mental energy, for the few rare opportunities that fall squarely in the center of your circle. This protocol transforms the circle of competence from a passive concept into an active, ongoing discipline of financial self-awareness. The antithesis of this focused, disciplined approach is what can be described as the dabbler's portfolio. This is the investment style of someone who has no defined circle of competence and is instead guided by the shifting winds of market fads and cocktail party chatter. Their portfolio is not a coherent strategy, it is a chaotic museum of recent manias. They own a little bit of a trendy software-as-a-service company because they read an article about it. They have a small position in a cannabis stock because a friend told them it was the next big thing. They bought a few $1,000s worth of a popular cryptocurrency during its last bull run. They have a stake in a Chinese electric vehicle company they can't even pronounce. They have a shallow, headline-level understanding of all of these assets, and a deep, fundamental understanding of none of them. Their trading psychology is entirely reactive. It is driven by a potent mix of greed when they see something going up, and fear of missing out, FOMO, when they feel they are being left behind. They have no core conviction, no long-term thesis for any of their holdings. Because they don't truly understand what they own, any market volatility sends them into a panic. They buy high in a state of euphoria and sell low in a state of despair. This is the opposite of the CEO mindset, which is defined by strategic focus and long-term vision. The dabbler is a tactician, constantly reacting to the noise of the market, and in doing so, they become their own worst enemy. Their portfolio is a testament to a lack of intellectual discipline, and the financial results almost always reflect that. They are perpetually busy, always trading, always in the game, but their frantic activity prevents the one thing that truly builds wealth from ever taking hold: the quiet, patient, uninterrupted magic of compounding. The direct financial connection of having a well-defined circle of competence is its profound impact on the strategy of asterisk portfolio concentration. The conventional wisdom pushed by much of the financial industry is diversification. Own a little bit of everything, they say, and you'll be protected. But for an investor who has done the hard work of defining their circle, this is terrible advice. As Buffett himself has said, diversification is protection against ignorance. It makes very little sense for those who know what they're doing. When you have a deep, almost cellular understanding of a business or an industry, you gain the conviction necessary to make large, concentrated bets when the opportunity arises. Instead of spreading your capital thinly across 50 stocks you barely know, you can concentrate it into 10 or 15 businesses that you have studied exhaustively and understand inside and out. This is how value investing generates its legendary returns. It is not about finding hundreds of good ideas. It is about finding a handful of truly great ideas and betting heavily on them. From a risk management perspective, this may seem counterintuitive. Is a portfolio of 10 stocks not riskier than a portfolio of 100? The answer is no, provided that those 10 stocks are all squarely within your circle of competence. The risk of an investment is not determined by its price volatility, but by the probability of permanent capital loss. Your deep understanding of your 10 businesses dramatically reduces that probability. A diversified portfolio of 100 businesses you don't understand is not a fortress, it is a minefield. You have no idea which of them are about to step on a landmine of competitive disruption, technological change, or management incompetence. A well-defined circle of competence, therefore, is the key that unlocks the power of concentration. It gives you the intellectual and emotional fortitude to build a portfolio that may be less diversified in name, but is far, far less risky in reality, because its single greatest asset is you and your specialized knowledge. Our fourth pillar serves as a solemn warning. We now enter the graveyard of geniuses, to study the cautionary tales of those who flew too close to the sun, their intellectual brilliance serving only to melt the wax on their wings. There is no story more fitting, more tragic, and more instructive than the rise and spectacular fall of long-term capital management, or LTCM. If you were to build a financial dream team in the mid-1990s, you would have created LTCM. Its founder was John Meriwether, the legendary bond trader from Salomon Brothers. Its partners included two Nobel Prize-winning economists, Myron Scholes and Robert C. Merton, whose work on options pricing was the theoretical bedrock of modern finance. These were not just smart people, they were the high priests of financial theory. They believed they had discovered the Holy Grail, a way to use complex mathematical models to exploit tiny, temporary pricing discrepancies in global bond markets, generating high returns with what they perceived as almost no risk. Their pitch was irresistible. They told their investors, who were primarily large financial institutions, that they were like a vacuum cleaner, sucking up nickels that were scattered all over the floor. Any single nickel was insignificant, but by sucking up millions of them, they could make a fortune. And for 4 years, they did. They generated astonishing annual returns of over 40%. Their confidence swelled into outright hubris. They believed their models, built by Nobel laureates, had tamed risk. They were smarter than the market. Blinded by this intellectual arrogance, they made a fatal mistake. They began to take on staggering amounts of leverage. For every $1 of their own capital, they borrowed over $25. By 1998, they had over $100 billion in assets on a capital base of less than $5 billion. Their bets were so vast that they were the single largest player in many niche markets. They had stepped outside the circle of competence of prudent risk management and into the realm of abstract mathematical certainty, forgetting that the real world is messy and unpredictable. The catalyst for their doom came from a place their models had not anticipated: Russia. In August 1998, Russia defaulted on its domestic debt. This was the black swan event, the unthinkable variable. Panic swept through global markets. Investors fled from anything that seemed risky and piled into the safest assets, like U.S. Treasury bonds. This flight to quality caused the pricing discrepancies that LTCM was betting on to widen dramatically instead of converging as their models predicted. The nickels they were trying to pick up turned into steamrollers coming right at them. Their leveraged positions began to bleed billions of dollars, day after day. They were trapped. Their positions were so large they couldn't unwind them without cratering the market further. In a matter of weeks, the firm lost over $4.5 billion and was on the brink of a collapse so massive that the Federal Reserve had to orchestrate a private bailout to prevent it from taking down the entire global financial system. The smartest men in the room had been wiped out by a simple, real-world event that their beautiful, elegant models had failed to account for. Warren Buffett, who was asked to be part of the bailout consortium, later remarked on the stunning failure of LTCM. To make money they didn't have and didn't need, they risked what they did have and did need. That is foolish. It is the ultimate cautionary tale of genius undone by hubris. The psychological demons that brought down LTCM are pathologies that can afflict any intelligent investor. The first is what we can call model blindness. This is the unconditional faith in a complex system or model, coupled with a dangerous ignorance of its inherent limitations. The partners at LTCM were seduced by the mathematical elegance of their formulas. They believed their models were a true representation of reality, when in fact they were just a simplified, incomplete map. They forgot the old adage, the map is not the territory. All models by their nature exclude the messy, unpredictable, and often irrational aspects of human behavior that drive markets, especially during times of panic. Their faith in their model blinded them to the real-world risks they were taking. The second psychological flaw was the narrative fallacy, a term coined by the writer Nassim Taleb. This is our innate tendency to create simple, coherent stories to explain complex and often random events. The narrative at LTCM was powerful and seductive. We are Nobel Prize winners. We have superior models. We are smarter than everyone else. Therefore, we cannot lose. This story was so compelling, that it allowed them to ignore the clear warning signs. It created a bubble of intellectual invincibility that was impervious to outside criticism. For any investor, for any entrepreneur, this is the danger. When the story you tell yourself about your own intelligence and your own strategy becomes more important than the objective facts of the world, you are on the same path that led the geniuses of LTCM to ruin. To avoid this fate, you need a mental model designed specifically to stress test your investment ideas against the lessons of the LTCM collapse. This is the Catastrophic Risk Assessment. It's a three-step protocol for thinking like a survivor. Step 1 is to identify the black swan. For any major investment you are considering, you must ask yourself, what is the single, unthinkable, out-of-model event that would completely destroy this thesis? Do not think in terms of a 20% market correction. Think bigger. Think about fundamental system-breaking changes, a sudden geopolitical event, a disruptive new technology that comes out of nowhere, a massive regulatory shift. The act of imagining the truly unthinkable forces you to appreciate the fragility of your own predictions and to build in a greater margin of safety. If you cannot imagine a scenario that would prove you wrong, your imagination is not working hard enough. Step 2 is the leverage litmus test. This is a simple binary question. Is there any form of leverage, financial, operational, or even psychological in this investment that could lead to a total and permanent loss of capital? If you are borrowing money to invest, using margin, the answer is obviously yes. But even without margin, a company with a huge amount of debt on its balance sheet has high financial leverage. A company with high fixed costs has high operational leverage. If the answer is yes, you must have a crystal clear understanding of how that leverage is contained and what could cause it to spiral out of control. This is the core of avoiding losses. Step 3 is to question the infallible algorithm. If your investment thesis relies heavily on a complex system, a proprietary model, a new technology, or any other kind of black box, you must subject it to this final question. What simple, stupid, real-world event could break this entire elegant system? The geniuses at LTCM were brought down by something as crude and simple as a country failing to pay its bills. Your brilliant software company could be disrupted not by better code, but by a simple change in consumer preferences. Your sophisticated trading algorithm could be broken by a simple regulatory change. This final step is about reintroducing a healthy dose of real-world skepticism to counter the seductive allure of complexity. It is about remembering that in investing, the simplest truths are often the most powerful. The path of the 99%, the antithesis to this paranoid discipline, is to believe the hype. This folly isn't limited to individual investors. It infects entire institutions and shapes market manias. It is the collective decision to suspend disbelief and abandon time-tested principles because of a compelling new narrative. We saw it with LTCM, and we saw it on an even grander scale during the dot-com bubble. The hype was that the internet had created a new paradigm for business, one where profits didn't matter, where valuation metrics were obsolete, and where endless growth was assured. This narrative was propagated by Wall Street analysts, venture capitalists, and even seasoned CEOs who should have known better. They collectively stepped outside the circle of competence of sound business analysis, which demands profits and sustainable cash flows, and entered the speculative world of chasing eyeballs and mindshare. They believed the hype. They invested billions in companies that were little more than a good idea and a fancy website. The stock market risk was ignored in favor of the narrative of infinite upside. When the hype died down and the old rules of economics reasserted themselves with brutal force, the consequences were devastating. The Nasdaq index lost nearly 80% of its value. Trillions of dollars in shareholder wealth were incinerated. This pattern repeats itself throughout financial history, with different assets and different narratives, but the underlying mistake is always the same. It is the failure to adhere to the fundamental principles of business valuation and the choice to believe in a seductive story over a hard-nosed analysis of the facts. It is the belief that "this time is different," which have been called the 4 most expensive words in the English language. The direct financial connection of this principle is to the two most powerful concepts in defensive investing: time leverage, dime leverage, dime leverage, dime margin of safety. The story of LTCM is the definitive lesson on the terrifying mathematics of leverage. A small 4% loss in the value of their assets was magnified by their 25-to-1 leverage into a 100% loss of their equity. Leverage is a double-edged sword that amplifies both gains and losses. When you are operating at the fuzzy edge or outside of your circle of competence, you are far more likely to be wrong. And when you are wrong with leverage, you don't just lose some of your money, you lose all of your money. The second concept, margin of safety, is the bedrock of all value investing. It is the principle of buying a security for significantly less than your estimate of its intrinsic value. This discount, this margin of safety, is your protection against unforeseen problems, analytical errors, or just plain bad luck. When you operate squarely within your circle of competence, your ability to accurately calculate a business's intrinsic value is at its peak. You understand the moving parts, the risks, and the potential, which allows you to know with a high degree of confidence when a business is truly on sale. When you venture outside your circle, your estimate of intrinsic value is just a wild guess. You have no real margin of safety because you have no idea what the business is actually worth. You are navigating in a fog without a compass. In financial terms, intellectual humility builds a fortress of capital by forcing you to avoid dangerous levels of leverage and to demand a significant margin of safety in all of your investments. It is the discipline that ensures your portfolio can withstand the inevitable shocks and surprises of the market, preserving your capital so it can fight another day. We arrive at our fifth and final pillar. This is where we see how the disciplined application of all these principles, humility, patience, and a relentless focus on what you know, comes together to create the ultimate financial outcome, the creation of a compounding machine that can build generational wealth. The perfect story to illustrate this is Warren Buffett's lifelong love affair with Coca-Cola. He made his major investment in the company in 1988, buying over $1 billion worth of its stock. The purchase came after the infamous market crash of 1987. At the time, many institutional investors viewed Coke as a mature, slow-growth, boring company. The exciting action was thought to be elsewhere. But Buffett, operating deep within his circle of competence of analyzing consumer brands, saw something else entirely. He saw one of the greatest businesses on earth, temporarily available at a reasonable price due to market panic. He didn't focus on the next quarter's earnings. He focused on the company's single, most valuable, and nearly invisible asset, its brand. He understood that the word Coca-Cola was instantly recognizable to billions of people around the globe, in dozens of languages. It was a symbol of refreshment, happiness, and the American way of life. This brand created what he called a moat around the business, a competitive advantage that was almost impossible for a competitor to overcome. He analyzed the business with stunning simplicity. He calculated how much of the world's population was in its prime consuming years and how many 8-ounce servings of Coke products they drank per day. He saw that in many parts of the world, that number was still very low. He envisioned a future where, for decades to come, that per capita consumption would slowly, steadily, inexorably rise. He saw the business not as a stock certificate but as a perpetual royalty on global human thirst. It was a simple, powerful idea, born from a deep understanding of the business and its place in the world. So he bought, and he held, and he held, and he held. Through recessions and expansions, through market booms and busts, he held. That initial billion-dollar investment has since grown to be worth over $25 billion, not including the tens of billions in dividends Berkshire Hathaway has received over the decades. The Coca-Cola story is the ultimate testament to the offensive power of the circle of competence. It shows that this principle is not about being timid or settling for small, safe returns. It is about patiently waiting with the discipline of a sniper for that one perfect fat pitch opportunity to appear in your sweet spot and then swinging for the fences with absolute conviction. It is how you move from merely preserving capital to creating a true fortress of wealth. The psychological superpower that enables this kind of long-term success is the mastery of two conflicting human impulses, delayed gratification asterisk, and the asterisk action bias. Delayed gratification is the ability to resist the temptation of an immediate reward in order to receive a more substantial reward later. It is the bedrock of all successful saving and investing. Buying and holding a great business like Coca-Cola for 30 years is an extreme act of delayed gratification. It requires you to forego the quick thrill of trading for the slow, methodical, but ultimately immense rewards of long-term ownership. This, however, runs directly counter to the action bias, our deep-seated psychological tendency to favor action over inaction, even when inaction is the more rational course. In the world of investing, the pressure to do something is immense. The news is constantly screaming, prices are always moving, and your brokerage account is a button click away. Most investors succumb to this bias. They are constantly tinkering, trading, rebalancing, chasing the latest trend. They feel that if they are not active, they are not being good stewards of their capital. Buffett's genius and the power of the circle of competence is that it provides the intellectual framework and the emotional conviction to fight this bias. When you understand your businesses as deeply as he understood Coke, you are not troubled by the market's daily gyrations. Your conviction gives you the strength to do the hardest thing in investing, absolutely nothing. This ability to patiently sit, to let your great businesses do their work, is the rarest and most valuable skill in finance. To build this skill into your own financial life, you can adopt a final mental model, the compounding machine protocol. It is a three-step discipline for shifting your mindset from that of a short-term trader to a long-term business owner. Step 1 is to define your fat pitch criteria. Based on your meticulously mapped circle of competence, take the time to write down, in advance, the exact and specific criteria for a once-in-a-decade investment opportunity. For example, a dominant company in an industry I know intimately, with a long-term return on capital greater than 15%, run by honest and able management, and available at a price that represents at least a 40% discount to my conservative estimate of its intrinsic value. Having these criteria written down serves as a filter, preventing you from getting excited about mediocre ideas and preserving your capital and attention for the truly exceptional ones. Step 2 is to institute a do-nothing portfolio review. Most investors review their portfolios looking for reasons to make a change. You must flip this script. Schedule your portfolio reviews, perhaps quarterly, with the explicit default action being nothing. The burden of proof is on the decision to buy or sell something, not on the decision to stay the course. This simple change in framing is a powerful psychological tool to combat the action bias and promote the kind of long-term holding that allows compounding to work. Step 3 is to write a generational thesis. For each of your core long-term holdings, write a one-page memo answering a single question. Why would I be happy to own this business, and only this business, for the next 20 years if the stock market were to shut down tomorrow? This exercise forces you to think beyond stock prices and quarterly earnings, and to focus on the fundamental long-term drivers of business value. It is the final step in the transformation from a speculator in stocks to a true partner in great enterprises. The antithesis to this patient, ownership-driven approach is the cult of activity. This is the world that the vast majority of market participants inhabit. It is the belief system that equates more activity, more trades, more research, more screens, more complexity with better results. Its disciples are the day traders, the market timers, the chart watchers, and the constant portfolio tinkerers. Their trading psychology is a chaotic whirlwind of emotional reactions to breaking news, price momentum, and the endless stream of expert predictions. They spend countless hours and immense mental energy trying to outsmart the market on a minute-to-minute basis. The financial industry loves these participants because their constant activity generates a steady stream of commissions, fees, and spreads. But for the investors themselves, this cult of activity is a death knell for wealth creation. Their frequent trading racks up enormous costs, both in direct commissions and in taxes on short-term gains. More importantly, their relentless churning prevents the magic of compounding from ever taking root. A seed that is dug up every day to check on its progress will never grow into a mighty tree. They are running on a financial hamster wheel, mistaking the feeling of motion for the reality of progress. It is a strategy that is exhausting, expensive, and ultimately a recipe for profound financial disappointment. They are playing a game they cannot win, while the true winners are playing a different game entirely, the game of sitting still. And this brings us to the grand conclusion, the final and most powerful direct financial connection. The entire philosophy of the circle of competence, of intellectual humility, and of patient long-term ownership is designed to serve one master, the unwavering mathematical law of asterisk compounding. Often attributed to Albert Einstein as the eighth wonder of the world, its power is not intuitive. A single penny, doubled every day for 30 days, becomes over $5 million. That is the explosive, geometric power of compounding. But there is a crucial and often overlooked caveat to this magic. The formula only works if the growth is uninterrupted. A long series of positive returns can be mathematically obliterated by a single, catastrophic loss. A portfolio that grows by 20% a year for 5 years and then loses 50% in the 6th year has a final return of almost zero. You are back where you started. The entire purpose of the circle of competence is to avoid that catastrophic 6th year. It is a system designed, first and foremost, for the avoidance of major permanent losses. By staying within the bounds of what you know, by acting with humility, by demanding a margin of safety, and by refusing to use dangerous leverage, you are systematically eliminating the most common causes of financial ruin. You are building a fortress of capital that is designed to withstand the storms. The final number on your net worth statement after 30 or 40 years of investing will be far more sensitive to the 1 or 2 stupid mistakes you avoided than to the dozen brilliant moves you made. This is the final promise. The circle of competence is not about being the smartest person in the market. It's not about finding the next 10-bagger or timing the next crash. It is about playing a game you can win by setting the rules yourself. It is the humble, disciplined, and ultimately invincible strategy for making sure that the unstoppable force of compounding is your servant, not your enemy. It is the path to ensuring that when the final accounting is done, you are the last one standing. You have made it to the end. That fact alone says something important about you. You have just invested a significant amount of your most valuable asset, your time, to download a complex mental model into your operating system. What you have just acquired is more than just a piece of financial trivia. It is a complete framework for decision-making under uncertainty. It is the intellectual architecture for risk management, capital preservation, and long-term wealth creation. You now understand the profound difference between casual familiarity and true competence. You see the psychological traps that ensnare even the most brilliant minds, and you are now armed with the practical tools to avoid them. This single idea, the circle of competence, when truly internalized, can protect you from the single greatest threat to your financial well-being, yourself. But it is crucial to understand that what you've just mastered is a single powerful node in a much larger network of thinking. The system that Buffett and Munger have built over a lifetime is not a collection of isolated tricks. It is a seamless, interlocking latticework of mental models, each one strengthening and informing the others. The circle of competence is the foundation, the principle that tells you where to play. But there are other models that tell you how to value a business once it's in your circle, how to assess the quality of its management, how to think about competitive advantages, and how to behave when the market is gripped by fear or greed. You have built the walls of the fortress, but now you must learn how to command the army within it. The journey of mastering this system is a process of assembling a complete mental arsenal. The video that is now appearing on your screen is not an accident. The algorithm has identified it as the next logical step in this journey. It is the missing link, the piece of the map that connects the principle you've just learned to the next level of understanding. Think of it as the connection between the what and the how. What you have just learned is the defensive strategy that keeps you in the game. That next video holds the offensive strategy for winning it. To click away now would be like learning how to build a world-class race car and then never learning how to drive it. The choice you face is not about watching another video. It is a decision about who you want to become. Are you a dabbler, content with a superficial understanding? Or are you a serious student of success, committed to completing your arsenal and mastering the game? The path forward is right in front of you. Continue your ascent. Click and install the next piece of the machine.